Dr. Satyanarayana, founder at the company and CEO of Laurus Lab, is with us. So congratulations on a great set of numbers. But, when I look at Laurus's numbers over the period of last 2 to 3 years, each time there is a new segment which is driving the number. This time it's synthetic or CDMO, how you want to call it. What was the reason for this? Is there any one-off in those numbers? One-off as in, sometimes some drugs come into demand. That's why there was an additional number. Is there anything like that?
Good morning. So if you look at our numbers, as you mentioned, there is a lot of diversification happening away from ARV, APIs, and formulations. If you look at, we heavily dependent on ARVs 2 years back, and that dependency came down very significantly, as you have seen in the Q1 numbers. About 42% of our revenues came from ARV, APIs, and formulations, whereas 37% of our revenue came from CDMO. So we have the ability to do course correction and diversify our business other than ARVs. It's not that the ARV volumes are going down. There was a price pressure. The revenue still we're very confident of clocking 3,000 crore APIs and formulation put together during the overall year. The significant growth came from CDMO, and that was because of our consistent efforts towards delivering value to our big pharma clients. And it took several years for us to become a recognizable player in CDMO and recognized as a strong, sustainable player now. We have very active projects and a lot of active clients now. We serve now 6 out of 10 big pharma. Like in generics, we serve 9 out of 10 big pharma. So we are recognized as a sustainable player in CDMO. That's the reason that division is growing. So we don't see a one-off revenue which we don't do in the future quarters in CDMO.
Okay. Mr. Chava, that brings me to my next question, whether or not you're sticking by with your 7,200 crore rupees revenue guidance and 30% plus margin guidance?
Yes, absolutely. We are on track. We have the ability and we have the capacity, we have the customers to reach our goal, and we are on track. And as we clearly indicated multiple times, this company has the ability to maintain EBITDA margins around 30%.
Okay, good to hear that, because the market really needed clarity on this. But tell me, as I look at your numbers, Mr. Chava, what's led to such kind of an increase in your other expenses?
See, in the Q1, we had increase in our fuel and power charges. In Andhra Pradesh, where our manufacturing facilities are located, there was a 50% restriction on the power usage. So we purchased power from the power exchanges, which led to almost power and fuel expenses were 25 crores more than what we anticipated in the budget. That's one. And second, because there was a notional forex loss of almost 23 crores because of the dollar rupee fluctuations. So these two led to the significant increase in the other expenses. Other than that, there is also increase in our manpower expenses. There was a lot of incentives given to our colleagues, and there were about 200, 250 new colleagues came to formulation as well as the new API expansions. Despite of that, you might have noticed that our gross margins increased very well.
So there is a ARV segment, there is a non-ARV segment for the company, and you said how you're moving away from the ARV segment. But the ARV segment in this quarter continued to slide. Will it remain stable for this quarter? Also, the non-ARV portfolio, how is that doing?
We do expect our ARV sales to increase further in the future quarters. So as an ARV, we have good market share. We didn't lose any market share for us to get worried. There was a price pressure, but we were able to withstand because of our scale, capacity, and the innovative chemistry what we apply. So we are not investing more into ARV API capacity or ARV formulation capacity. We have enough capacity to meet the market demand. So our new capex is going into non-ARVs, APIs, non-ARV formulations, and into the CDMO division. So I think the growth for the company will come in non-ARV in the future.
I mean, last to last year, financially, I'm talking about, was a great year for the company. I mean, really the discovery of Laurus Lab in terms of investors. Last year, you did not see that great numbers. But now with tenders in South Africa, some of the other places opening up, we are going back to the pre-COVID level. You think normalization will be achieved across segments?
See, as I mentioned, our ARV, we have enough capacity to meet market demand. So I think order book for ARVs is going up. We are very happy for that. And there was slight dip in the formulations in Q1, but we hope things will be better in the coming quarters for this financial year. So overall, API, ARV APIs and formulation volumes, we are very confident. But because of the price pressure, the margins went down in ARVs, but that was significantly offset by our high growth, high margin non-ARV and CDMO businesses.
Thank you so much, sir, for taking out time for us. Always good to get perspective from you. That was the management at